Welcome back, everyone. We have a lot of news to get into in this episode. The market is up huge. The S&P 500 across the board is mostly green. Companies are having incredible rallies today. Companies like Amazon are up over 11%. The inflation report came in. It was better than expected. That's what's spurring a lot of this market volatility and all of this green in the market today. We have the trends of inflation that we're going to be looking at. I'll give you an update on my opinions on it. We have my update on the Story Fund and its performance compared against the S&P 500, and we have specific news on Amazon. They're doing the meta move now. They're doing cost cutting. They're focusing on unprofitable portions of the business. So we have a lot to jump into in this episode. If you haven't already, hit subscribe, hit like on the video. Let's go ahead and dive right in. Now, again, I do something different than most YouTubers. If you follow this channel, we have a level of transparency here that you don't see too often. So this might be shocking to see if you're a new member here, but I show you my performance in totality, all of it, even if it's not good, even if the market's going down, even if it's unpleasant to look at. I'll show you that anyway. And I'll show you as well when this eventually recovers, because I think eventually this portfolio will recover. Now, having said that, there's something that I want to point out on the Story Fund here. This is a tech portfolio that I've been following since, beginning of 2021. So I started this one at a bad point, but I just want to point out, this is not my only portfolio. For those of you not aware, I have a whole nother dividend portfolio that's substantially larger than this one. It's performed a lot better over the past couple of years, and I follow that one on a different channel. Just YouTube my name to find it. So, but this is one that I am focusing on. I do want to do really well with this one, and the objective is to invest in high quality, highly scalable tech companies that I think will have outperformance over the next 3 or 4 years. Now, I'm looking at companies like here that have just been devastated over the past year. Amazon, Netflix, Microsoft, Google, you name it. What's happened over the past year? Inflation has gone up like crazy. The Fed has responded to all of this inflation by raising interest rates like crazy. Interest rates moves the discount rate up, or the opportunity cost, which is a lot of financial jargon, but it basically acts like gravity. Every company comes down in price, like we've seen over the past year, but companies that have their profits further out in the future come down even more. Companies like Amazon and Netflix. So they have been in a very unfortunate situation of their stock price getting crushed because of inflation, spurring further Fed interest rates. Well, what's happening today? If we zoom in on the 1 day here, we are up almost 9%. $7,600 just today. So when we look at these big losses here, we look at $44,000. Keep that in mind. Sentiment can change on a dime, and it often does. These companies that are considered right now by market participants to be worthless, as of yesterday, they're just garbage companies. Sell out of them. They're not hot anymore. They don't matter. That's sentiment following price. Price has come down for these companies over the past year. That makes sentiment go so negative. And investors actually get into a trap here. As the price comes down for companies, we've seen this over and over again. As the price comes down, sentiment turns negative and people become bearish on companies that they were once bullish on. Great companies like Netflix and Amazon. Many people think that these two companies are basically worthless. They're just not worthwhile anymore. I haven't had my sentiment change on these companies at all, even with the price decline. I look at what I think will be the future cash flows of them, and I still think it will be substantial. So on days like today, on the 1 day, Amazon's up 11.6%. I'm up $3,300. Netflix is up 6.49%, another $1,000 there. This doesn't really change my sentiment, and that's something that I think is important. I still view these companies as future cash flows down the road. Whatever direction they trade in the meantime is inconsequential. The way that I want to be paid back is by their cash flows. But regardless, this is a pretty exciting day in the market. It's a pretty positive day. We have everything across the board in this portfolio heavily in the green. Microsoft up 6%, Google up 7%, Adobe up 9%, Salesforce up 8%, Apple up 6%, Berkshire up 3.9%, and then Crocs up 10.7%. It's a big one. Overall, the portfolio is still in the red, but this is a pretty positive direction. Now, again, what is spawning this big move in the market? Why are investors so bullish? What has caused stocks to come down for the past year? Inflation going up and the Fed raising interest rates. That again has this big thing that it does where it adjusts the discount rate. Treasury yields go up, making stocks less appealing to investors because now investors have other options to get a yield. So if we see anything of this reversal, if we see interest rates coming down and inflation coming down, that'll have the opposite effect. It'll raise stocks. And that's what we see in this report. The October inflation report came in at 7.7%. Now, looking at this from the sidelines, you might think that's still a lot. Inflation is still really high. 7.7%, that's almost 8%. That's still really bad. That's not the real way that you should be looking at this. The way to look at this is through the lens of expectations and trends. First of all, the expectations. A 7.7% reading in October is better than almost anyone expected. Almost anyone. There are some people calling it. Jeremy Siegel is one of them. He was on CNBC saying inflation is coming down. It's already gone and the Fed is working with past data. But most people, most analysts, most investors, most forecasters and economists were predicting a reading of anywhere from 8.2%, 8.1%, 7.9%. None of them were really saying 7.7. This came in lower than expectations, much lower. And that's the first thing. Now, to add more context to this, we can look at the actual trend here. Here's the month-over-month inflation reading. Last month, we had 7.7%, which again, out of context, just in and of itself, is a very high reading. But when we look at the trend, we can see a clear trend of inflation coming down, generally speaking, month over month. And this is a reversal of the past couple of years when it's been only going upwards. Investors are future looking. They're looking at what's going to happen, not currently what has already happened. Right now, it looks like inflation is on a steady trend downward. If that continues, that is good news for investors. It means that Jerome Powell has some ammo. He has some actual data that's real data, historical data, to show that he can take his foot off the gas pedal. He won't have to raise interest rates quite as much. And that's good news for the economy. It means there's less of a chance we go into a terrible recession. It's good news for investors because the interest rates aren't as high. It's good news all around. So in my opinion, I think it's appropriate for the market to react this way. I think this is something to celebrate. Not necessarily that stock prices are getting higher, but that inflation is coming down. That is objectively a good thing. Now, one company in particular had not only good news that inflation is coming down. As a retailer, it's good for Amazon to have inflation coming down. But Amazon also has some additional good news today. They are going to be focusing on profits for their company to some extent. They say Amazon, in a broad cost-cutting review, weighs changes at Alexa and other unprofitable units. Amazon is a very vast, diverse, complex business. It's like a tech conglomerate of sorts. And many of the company is profitable. There's a lot of it that is profitable. In fact, the three most profitable parts of the company are the Amazon Prime membership, the AWS business, and the ads business. They have high margins, they're service-based businesses, they generate a lot of profits that Amazon uses to invest in different parts of the company. But over the past couple of years, it's become clear that Amazon's free cash flows continue to go down while their expenses continue to go up. And investors have become increasingly impatient. So having the management team, having Jassy finally say, we're paying attention to the cost structure of the company, we actually want to generate some free cash flow. Well, to many investors, that's like music to their ears. That's exactly what they want to hear. And keep in mind, Meta just recently did the same thing. We heard Mark Zuckerberg write a letter to employees of the company, which if you're a Meta investor, I think you should read it. That was the most bullish letter, the best thing that Meta has done over the past year. He said that we're focusing on cost structure, profitable growth. We're laying off different employees in different divisions. We're going to become a more lean, profitable, future-looking company. He addressed so many different things with the company and the bloat, the excess hiring, so many problems that Meta's facing. Mark Zuckerberg addressed them all in a single letter. And I thought, again, it was fantastic. I'd recommend reading it. But at Amazon, we see them doing something similar. At Amazon, they say, between the end of 2019 and the end of 2021, Amazon hired more than 800,000 employees. 800,000. Mostly at its hundreds of warehouses as it sought to keep up with surging online orders. During the pandemic, it also struck deals worth more than $10 billion combined on acquisitions of robot device makers, movie and television studios, and primary care healthcare companies. The retailer is continuing to invest in parts of the business where it sees growth potential, such as healthcare. So Amazon has made huge investments with their employees. All these employees in warehouses and in their corporate offices, many of them requiring lots of CapEx and uniforms and gear to get started, lots of training. They're expensive, particularly when they're first hired. Employees are more efficient after 6 months. So hiring this many employees at once is a massive expense. And to many of them, it's also stock-based compensation and different hidden expenses. Overall, this is very expensive to the company. Then additionally, Amazon just doubles down and triples down with their investments, putting more money into robot companies and buying MGM and buying healthcare companies, spending $10 billion plus worth of investments. And this is at a time where most people, including the former CEO of Amazon, Jeff Bezos, that the economy is slowing down and going into a recession. Earlier, a month ago, he said, yes, the probabilities of this economy tell you to batten down the hatches. So this is the news for Amazon. They are now focusing on cost structure, similar to Meta, and I expect investors to look at this and see it positively. I view this mostly positive. I think that companies should be able to grow and do major investments, but I still think they should do it with profitability. I think the big risk for Amazon, and I say this as an Amazon shareholder, is just too much rapid, unconstrained expansion, too much bloat, not paying attention to profitability or cost structure, and becoming a company like General Electric, right? A big bloated company that ultimately runs into a lot of problems because they're not focused on making money. Amazon's a big company. I want them to continue making investments in all different things, but I also think it's important for them to focus at some point on getting a return on their investment, and we see them doing that. So I'm excited for Amazon. I'm excited for my portfolio today, but overall, this really doesn't change my outlook on these companies. I don't expect to get paid back by Netflix and Amazon by timing market hikes and market prices and selling at the top. The way that I'm investing as a value investor is looking at future cash flows. I think these companies will generate massive future cash flows. The way that I want to be paid back from Amazon and Netflix and Microsoft is through dividends and buybacks, not by timing the ups and downs of the market. So even though today's an exciting day, it's a fun day, I don't want to take away from that. I also think it's important to keep a long-term perspective. These days come and go. Volatility comes and goes all the time. Pay attention to the future cash flows. Invest wisely. That's all for this episode. See you in the next.